Good morning. This is an open meeting of the U.S. Securities and Exchange Commission on September 18th, 2024, and I want to welcome members of the public listening in through our website, sec.gov. Today, the Commission is considering one matter, and I look forward to discussing this recommendation from staff. As I said, the Commission's just one matter today, but we're considering updating rules for the $55 trillion equity markets here in the U.S. I'm pleased to support these rules because they would enhance competition, and enhance efficiency, enhance fairness, benefiting investors and capital formation alike. Now, if I can roll back the clock a little bit, in 1975, when the Commission was already some 40 years old, 41 actually, Congress tasked the Securities and Exchange Commission with responsibilities to facilitate the establishment of the national market system and enhance competition. We'd already been around for 41 years, but Congress felt there was more to do to facilitate the establishment of the national market system and enhance competition in the securities markets, including the equity markets. This was based on a lot of history then, but based on these new authorities, new technology, new national market system, starting in 1978 and all the way through 2005, the Commission has taken up a number of actions promoting the efficiency, competition in the equity markets with a national market system in mind. Well, a lot's changed in technology and business models since we last took a comprehensive review. We've done some important targeted things, but since the time we last did a comprehensive review in the national market system rules, these rules were called Regulation NMS for National Market System back in 2005. First, transaction volumes in the listed equity markets have doubled just in the last 5 years and tripled in the last 17 years, so a lot more volume. Second, the markets have moved to overwhelmingly trade electronically. Third, stocks representing approximately 74% of share volume, so 3/4 of share volume, are currently being quoted at less than a penny and a half per share. This, just by reference, compares to about half of the stock, or 54%, that were quoted in less than a penny and a half back in 2005. Fourth, a large and growing portion of the market is being transacted off exchange in what many call the dark markets. As of 2023, approximately 45%, or nearly half, of share volume was executed in the dark markets, up from just a quarter being done so, or 25% back in 2009. And lastly, there's been a significant increase in everyday investor participation in the markets. Per Federal Reserve statistics, about 58% of American households own stocks. So a lot's shifted in these last 19 years. But what's remained the same is Congress gave us a mission back in 75 to stitch together this national market system and promote efficiency and competition. Thus, I think it's incumbent upon us to update our national market system rules. I believe the updates we're considering today will help drive greater efficiency, greater competition, greater fairness in our equity markets. The updated rules would relax, I repeat, relax a minimum called the 1 penny minimum on quotation increments first adopted in 2005. For many stocks under the updated rule, a new minimum, which would be just a half a penny, this would be important. Reducing what's known as the tick size will benefit investors and market participants by allowing stocks to be priced more efficiently and competitively. This will lower cost for investors, as well as improving liquidity, competition, price efficiency. Little bit of history. I know you know I like history, but when I started on Wall Street, markets were quoted in fractions of a dollar, usually quarters and eighths. This was the case all the way since the late 18th century, quarters and eighths and the like. By the 1990s, though, stock exchanges had shifted their rules to allow quotes in sixteenths of a dollar. equivalent of 6.25 cents. And investors yet were still clamoring, this is in the 1990s, clamoring for lower quote increments. Such wide spreads, even at 6.25 pennies, such wide spreads may have benefited brokers and dealers, but investors benefit when quoted spreads are tighter. Thus, in the year 2000, 24 years ago, the SEC required exchanges to move to what was called decimalization. Basically, no longer doing these quarters, eighths, sixteenths. Market participants would be allowed to decide the minimum quote as long as it was in decimals. We didn't mandate, by the way, how many decimals, but just as long as it was in decimals. In doing so, the commission stated that, quote, it believes that the decimal pricing could benefit investors by enhancing investor comprehension, but also facilitating our markets being more global and potentially reducing transaction costs. This was the key, reducing transaction costs. Later, we proposed this so-called regulation NMS back in 2004, and the SEC once again observed that the move to decimals also has reduced spreads because we had already moved to these decimals a few years earlier, thus resulting in reduced trading costs for investors entering orders, particularly for smaller orders that are executed at or within the quotations. Now, the commission also observed another thing, and that while there were really significant benefits justifying decimal pricing and being able to quote, and basically at whatever spread you wish, helping small orders go through the market, there were potential costs when some market participants used de minimis quotes. This was called stepping ahead or pennying, and they had different words to it, but stepping ahead of resting limit orders, which are so important providing liquidity to the markets. So the commission, for the first time in 2005, actually put a restriction on the markets. We had not had this previously. The commission said that so-called sub-penny rule was that there was a minimum quotation. Again, a lot's changed since then. First, I think it's time to relax this limit on the market. The 1 penny minimum has become outdated. It's too wide for many stocks. As I mentioned, in 2023, approximately 3/4 of share volume is being quoted at less than 1.5 pennies. While the commission sought public comment also on possibly reducing the tick size even further, I think it's appropriate to take an incremental step, allow trading centers to quote down to 0.5 penny. We had also proposed possibly going further. Second, in light of relaxing that minimum for quoting, it's also appropriate to lower a maximum fee that can be charged to access the orders, the limit orders on the exchanges. You see, back in 2005, the commission set a cap on the access fee at 0.3 pennies that the exchanges could charge. And this was important because we'd had another rule called the order protection rule, where market participants had to access these the best bid and the best offer. As the commission said back in 2005, for quotations to be fair, for quotations to be useful, there must be some limit on the extent to which the true price for those who access quotations can vary from the displayed price, because access fees basically distort the market in a way that the actual pricing is different than the displayed price. And over the years, well before the last 2 or 3 years that I was in this job, over the years, the commission has received many requests to lower the cap to both address market distortions and reflect the changes since 2005. And the release today has a lot of discussion on this, but I'm going to mention 5 areas real fast as to why folks thought lowering the access fee made sense. 1, the current access fee undermines price transparency. 2nd, it introduces unnecessary complexity. 3rd, it adds to market fragmentation. 4th, it raises potential conflicts between the brokers on one hand and customers on the other. And 5th, it benefits sophisticated market participants at the expense of other market participants. These are the inputs that the SEC had gotten over really years in lowering the access fee cap from 0.3 of a penny to 1/10 of a penny, together with the changes of the minimum quotation increment, will lower cost for investors. Now, there's some other things we're doing this rule that Hashang and Kelly and Jessica will review. We're updating rules to ensure that traders can determine at the time they execute a trade any rebates that happen. Our market structure is such that on one side somebody pays an access fee, and yet the exchanges then often rebate a significant portion of that 0.3 of a penny to another market participant. But right now it's not easy to determine what that is at the time of the trade, and our rules today would bring transparency to the level of rebates along with lowering the access fee. Fourth, the final rules would implement an updated definition of round lot. You see, there's a definition of round lot that's been around for over 120 years. It's 100 shares. Anything above 100 shares gets certain order protection. Below 100 shares, called an odd lot, has different mechanisms. I think that this age-old 100-share level no longer reflects today's markets. A prior commission had put this in as part of the market infrastructure rule, but it had not yet been implemented. So we're ensuring that it goes into effect now, and people will benefit from this, and it will broaden out the best bid and best offers. So round lots will go, instead of 100 shares, depending upon price, they might be 40 shares, 10 shares, or even 1 share for the very high price stock. And then finally, we're updating rules about greater transparency on the quotes on smaller orders, so-called odd lots. Look, together, I think these reforms are going to really help promote greater transparency, promote greater competition, greater fairness, greater efficiency, and I will say again, $55 trillion equity market. It's about little under half of our total U.S. capital markets. Believe it or not, it's close to half of the worldwide equity markets. But I think promoting this greater transparency and competition efficiency goes to the heart of the SEC's mission. I think the reforms are pro-investors. I think they are pro-capital formation. Look, we're going to list on our website so many people that have worked on this beyond the 5 of us, the commissioners and our staffs, but the divisions of trading and markets, Division of Economic Risk Analysis, the Office of the General Counsel. I direct folks to go to our website, sec.gov, for a full list of the names of all the folks that contributed to this release. But I'm going to turn it over to Hashang Zhu, our Director of Trading and Markets. He's going to be followed by Kelly Riley, who's been the team lead on this, and then Jessica Wachter, our head chief economist. So Hashang, over to you.
Thank you very much, Chair. Good morning, Chair Gensler and Commissioners Peirce, Crenshaw, Ueda, and Lizarraga. Today, the Division of Trading Markets recommends that the Commission adopt amendments to certain rules under Regulation National Market System, also known as Regulation AMS. The Commission adopted Reg AMS in 2005 to modernize and strengthen the regulatory structure of U.S. equities market, to support the public interest and the protection of investors, and to help ensure fair and orderly market for the execution of orders in AMS stocks. Nearly 2 decades later, the technology and economics of trading have evolved significantly, as the Chair previewed, and certain rules need to be amended to address issues about their operation in the current national market system. Specifically, the Division recommends that the Commission adopt amendments to Rule 612 of Regulation AMS about tick sizes, and Rule 610 of Regulation AMS about access fee caps. Additionally, the Division recommends that the Commission accelerate the implementation of certain rules about round lots and odd lots that were adopted in 2020 as part of the market data infrastructure rules. All of these amendments are designed to enhance competition, efficiency, and transparency in the national market system and reduce transaction costs for investors. First, As adopted in 2005, Rule 612 established a 1 penny minimum price increment for quotations and orders for all AMS stocks that are priced no less than $1 per share. Such a minimum price increment is also known as the tick size. Over the years, a significant and growing percentage of AMS stocks, whether measured by volume or number, have been constrained by the 1 penny tick size, meaning that the bid-ask spread is quite often 1 penny. Liquidity providers would be willing to quote a tighter bid-ask spread on these stocks, but they cannot do so under the current 1 penny tick size. Therefore, the division recommends that the Commission relax such regulatory constraint under Rule 612 and adopt a second, smaller minimum price increment of a half a penny for quotes and orders priced at $1 more for certain AMS stocks. The division believes that assigning a half penny minimum price increment to certain AMS stocks based on a transparent and objective standard, which is the spread, will increase price competition and reduce transaction costs for investors by narrowing down the bid-ask spread. Second, related to the division's recommendation to reduce tick size for certain AMS stocks, as well as to address distortions that have been developing in the national market system, the division also recommends that the Commission amend Rule 610 to reduce the access fee caps that are in place for accessing protected quotations, and to access the best bid and best offers of national security exchanges and the national securities associations. Under Rule 610C, also adopted in 2005, trading centers cannot charge more than 30 mils or 30 cents per 100 share for accessing protected quotations priced at $1 more and the best bids and best offers of exchanges and the national security associations priced at $1 more. Now, the corresponding fee cap for protected and other best quotations priced less than $1 is 0.3% of the quotation price per share. Related to our recommendation to add a half penny minimum price increment to Rule 612, we are also recommending that the access fee caps be amended to prevent introducing new pricing distortions in the market. Today, many exchanges charge the maximum fee cap allowed under the rule and primarily use these fees to pay rebates to market participants that provide liquidity. Now, these fees and rebates models have created concerns relating to price transparency and the potential conflict of interest, among other concerns. Now, to address these concerns, the division recommends that the Commission reduce the access fee cap to 10 mils or 10 cents per 100 share for all protected quotations priced at $1 more, as well as other quotations of trading centers that are the best bids and the best offers of National Security Exchange or the National Security Association priced at $1 more. The division also recommends an access fee cap of 0.1% of the quotation price per share for protected quotations priced less than $1 per share. Further, the exchange fee schedules in many cases contain fees and rebates that are calculated only at the end of the month. Now, this practice impedes the ability of market participants to understand the amount of fees or rebate that would be applied to a particular order at the time of execution, which in turn can impede all the routing decisions and the best X analysis. Therefore, the division also recommends the addition of a new rule, 610D, to require that all exchange fees and rebates be determinable at the time of execution, so that the market participants may understand and calculate the price of a transaction at the time of execution. Finally, the division recommends that the Commission accelerate the implementation of round lot and out lot information definitions that were adopted with the Market Data Infrastructure Rules of 2020. Currently, public information about AMS stocks quotations is provided in round lots, which exchanges define as 100 shares for most AMS stocks. Information about out lot orders, in other words, orders in the size less than a round lot, is not included in AMS information and only available on exchange prop data feeds. Under today's amendments, the round lot and out lot information definition will be implemented so that AMS stocks priced over $250 per share will have round lot sizes below 100 shares. Prices and sizes of out lot orders priced better than the national bid and best offer will be publicly available as part of AMS information. This will increase transparency for small-sized, better-priced orders. Additionally, the division recommends that the Commission adopt an amendment to the definition of allowed information to include the new data elements for the best priced allowed orders available in the market. This amendment will help investors, especially investors that trade orders with small amounts, to assess the current state of the market. My sincere thanks go to the many market participants and investors who submitted comment letters on this proposal. I also want to thank the trading market rulemaking team led by Kelly Riley, and including John Dumler, Steve Kwan, Mark McHale, Leah Roth, and Alba Bass from the Office of Market Supervision for their extremely diligent and thoughtful work. And finally, my gratitude goes to our colleagues from across the SEC, including staff in the Division of Economic Risk Analysis and the Office of the General Counsel for their invaluable input in preparing today's recommendation. I will now turn this over to Kelly to discuss the amendments in more detail. Thank you.
Thank you, House-John. Good morning, Chair Gensler and Commissioners. Today, the Division is recommending that the Commission amend certain rules under Reg NMS to address needs in the current national market system. These amendments would help to ensure that the national market system continues to protect investors and operate in an efficient, competitive, fair, and orderly manner and consistent with statutory objectives. As House-John mentioned, this recommendation contains three main elements. First, the Division recommends that the Commission amend Rule 612 to adopt a smaller minimum pricing increment for quotes and orders in certain NMS stocks. Second, we recommend that the Commission amend Rule 610 to reduce the access fee caps and to increase transparency about exchange fees and rebates. And third, we recommend that the Commission implement the round lot and odd lot information definitions that were adopted as part of the market data infrastructure rules. As House-John mentioned, for Rule 612, we recommend that the Commission adopt a new, smaller minimum pricing increment of ½ cent for quotes and orders that are priced $1 or more in certain NMS stocks. NMS stocks that have a time-weighted average quoted spread of 1.5 cents would be assigned to the smaller new increment. The amendment would relieve the constraint that these stocks face with the 1 cent minimum pricing increment that has been required under Rule 612 and would allow them to be priced more aggressively within the spread. As part of the amendment, we recommend that all NMS stocks be evaluated during an evaluation period, which would occur 2 times per year. The time-weighted average quoted spread for each NMS stock would be calculated using trading data collected over a period of 3 months during the first and third quarters of a given calendar year. The primary listing market for a particular NMS stock would perform this calculation and assign the minimum pricing increment to each NMS stock, which would be effective for 6 months. Finally, there would be a 1-month implementation period to provide the market with time to update systems to reflect the applicable increment that would be in place for the following 6 months. The Rule 612 amendments would ease restrictions under the current rule, reduce transaction costs for market participants, including investors, and allow prices to be determined in a more competitive manner. Under Rule 610, the access fee caps for trading centers caps the fees that trading centers can charge for accessing protected quotes, as well as other quotations of trading centers that are the best bids or best offers of a national securities exchange or national securities association. There are 2 access fee caps under the rules that are based on the price of the quotation. These quotations are priced $1. The quotations that are priced $1 are subject to an access fee cap of 30 mils per share, and quotations that are priced less than $1 are subject to a cap of 0.3% of the quotation price per share. We recommend that these access fee caps be reduced to 10 mils per share for protected quotations priced $1 or more, and to 0.1% of the quotation price per share for such quotations priced less than $1. These reduced access fee caps would prevent pricing distortions from occurring once the ½ cent minimum pricing increment is introduced. Further, under the current access fee caps, fee and rebate models have been adopted in the national market system that have created market complexity and raised issues related to pricing distortions, pricing transparency, and potential conflicts of interest in order routing. The recommended access fee caps would help to address these issues. We also recommend that all exchange fees and rebates be required to be determinable at the time of execution so that market participants may understand and calculate the price of a transaction at the time of execution. Currently, many exchanges calculate and bill members after the fact at the end of a month based on that month's volume, and this makes it difficult for market participants to understand and calculate their transaction costs at the time they execute a trade, make order routing decisions, and evaluate execution quality. Finally, in 2020, the Commission approved the market data infrastructure rules, but their implementation has to date been delayed. We recommend that the Commission accelerate the implementation of two definitions adopted as part of the market data infrastructure rules to expedite the availability of important market data to market participants and the investing public. Specifically, the Commission adopted a round lot definition where NMS stocks with an average closing price above $250 per share will be assigned a round lot that is less than 100 shares. This definition will improve transparency about smaller sized orders and higher priced stocks. The Commission also adopted a definition of odd lot information, which will improve transparency about odd lot orders that are priced better than the national best bid or national best offer. As part of the current recommendation, we also recommend that the Commission amend the definition of odd lot information to include a specified data element for the best odd lot orders to buy and sell, which would further provide important transparency to investors. Now I will turn this over to Jessica Wachter, the Director of Division of Economic and Risk Analysis, to discuss the economic impact of these amendments. Thank you.
Thank you, Kelly, and good morning, Chair Gensler and Commissioners. As you've heard, today the Commission is considering adopting a reduced tick size for some stocks, reduced caps on access fees, and accelerated implementation of certain parts of the market data infrastructure rules, and a requirement that fees and rebates be determinable at time of trade execution. Under current Rule 612, stocks priced at or above $1 can be quoted at increments of a penny and no finer. These amendments would allow quoting in increments of half a penny for stocks with sufficiently narrow bid-ask spreads. This change would allow market participants to better compete by quoting higher bids and lower offers, thereby lowering transaction costs for investors. These amendments would also reduce access fee caps. Absent a reduction, the current fee of 30 mils would be more than half the new tick size. This leads to price decoherence, which occurs when the ranking of prices on exchanges no longer represents the same ranking as sorting on prices net of fees and rebates. The amended fee of 10 mils would align with lower ticks and avoid the extra complexity and cost that would come with multiple caps. The MDI release identified many benefits to round lot reform and to odd lot transparency. These amendments would now be realized sooner. Finally, requiring fees and rebates to be determinable at the time of execution would reduce uncertainty regarding total cost of trading. We expect the amendments to come with compliance costs, such as the cost to exchanges to implement the new tick sizes. There would be costs associated with greater message traffic and more market data. The smaller tick would spread displayed liquidity over more pricing levels, potentially increasing the complexity of executing some orders. However, the targeted nature of these amendments would reduce these costs. In closing, I thank my colleagues in the Division of Trading and Markets and the Office of the General Counsel with whom we have worked closely during the development of these amendments before the Commission today.
Thank you, Jessica, Hishang, and Kelly, and so many others, to many more than we can name here today. But over to you, Commissioner Peirce.
Thank you, Mr. Chair, and thanks to Kelly, Jessica, and Hishang for your presentations. The final rule before the Commission today is a significant improvement over the proposal. It replaces an overly granular set of minimum pricing increments with a more reasonable single additional increment at half a penny. It replaces a 1-month review period for determining each security's appropriate tick size with a more generous 3-month review period, and makes adjustments to the minimum tick size for each stock only twice a year rather than once each quarter. It abandons an ill-advised proposal to mandate minimum trading increments across exchanges and off-exchange transactions. It provides a longer implementation period and commits the Commission to conducting a study of the rule's effects and outlines how the Commission will determine whether the rule has achieved our objectives. Together, these changes should reduce operational complexity and potential investor confusion, allow tick-constrained stocks to trade at prices more closely approximating their natural levels, permit continued competition across exchange and non-exchange trading platforms, and lower investors' costs of trading. Moreover, the accelerated implementation of certain provisions of the market data infrastructure rule that will bring additional transparency to odd lot orders should improve investors' ability to attain better pricing for certain orders. Because the final rule represents an incremental step toward addressing a problem, tick-constrained stocks, that appears to be broadly recognized by market participants, I support it. I'm not entirely happy, however, with the path that we took to get here. Procedural shortcuts leave me less certain about the outcome than I would like to be. Although I supported the proposal, I did so with reservations. Many commenters expressed their own deep misgivings over the needlessly complicated nature of the proposed rule and the difficulty of predicting how multiple overlapping changes would affect the behavior of market participants, including their willingness to provide liquidity on exchanges. Although the final rule is dramatically simpler than what we proposed nearly 2 years ago, and thus less likely to result in the harms that commenters predicted, we would have benefited from another round of comments and even a public roundtable on a rule that more closely resembled the final rule that we're considering today. Alternatively, the rule could have phased in its requirements over time to lower the risk of significant market disruption from making too many changes at once. Another step in the rulemaking process is painful for everyone, but making sure that we get such a consequential rule right warrants a little pain. I'm willing to support the final rule notwithstanding my concerns. After extensive conversations with the staff, I'm persuaded that the final rule is an appropriate response to the problem of tick-constrained stocks. In addition, the adopting release, as I've already noted, commits the Commission to performing a review that will help provoke reflection by the Commission and vigorous debate both within and outside the Commission about the actual effects of the rule and make it more likely that the Commission will make any necessary adjustments to the rule. I hope this is a step toward a more rigorous and consistent habit of establishing at the outset of the rulemaking process clear metrics by which we plan to measure a rule's success. I would like to thank the staff in the Division of Trading and Markets, the Division of Economic and Risk Analysis, and the Office of General Counsel, as well as in other offices throughout the Commission for your hard work on addressing commenters' concerns and developing a recommendation that represents a reasonable step forward. I do have a few questions for you. First, several commenters strongly urged the Commission to delay adopting this rule, along with the still outstanding best execution and order competition rules, until Rule 605 is fully implemented. Waiting to see that updated Rule 605 data would allow us to determine whether the remaining rules were actually necessary and would allow a more reliable comparison of the changes affected by each rule. Why isn't that the right course, delaying until we can see the 605 data?
Thank you, Commissioner Person. I'll try to answer your question. I think the amendments recommended in this release are not dependent on Rule 605 data, nor is data from 605 reports necessary before the Commission can make the changes that we recommend in this amendment. While the 605 amendments will bring improvements to disclosures for order executions of NMS stocks, the Reg NMS amendments address other concerns relating to investors trading and lack of transparency in the national market system. For example, quoted spreads of NMS stocks could not get tighter than the 1 cent minimum pricing increment under the pre-existing Rule 612.
Another suggestion from commenters that we take was that we take a phased approach to implementing the different changes. We could implement the market data infrastructure changes first, followed by tick size changes, and only then implement access fee caps. Such an approach would allow the Commission to look at how each step was affecting the markets independently of the other steps. Why aren't we taking that kind of an incremental step approach? Are we going to be able to determine the effect of each of these pieces if we're doing them all at the same time?
Commissioner Peirce, thank you for this question. I'm happy to answer this one. So the specific order that you mentioned, right? So having data infrastructure changes first, and then tick size, and then fee cap may result in a situation where the access fee is actually more than half of the tick size for certain stocks. As Jessica mentioned earlier, I think there might be distortions. There will be distortion introduced that way. But I take the merit of the question being, as we implement the various elements of the amendments together, is there a way to discern their respective impact on the market? I think the answer is yes. One could isolate and disentangle the impact of different elements because of the nature of recommendation. The recommendation is such that the study is possible because different stocks are affected differently under these recommendations. To maybe just add some technical details, one could use certain econometric techniques to isolate the impact of specific amendments. Just use one example. Let's say you want to study the impact of the tick size change. Now, one could compare stocks that have spreads just below 1.5 penny and the stocks that have a spread just above 1.5 pennies, right? Controlling for all else, the difference between these two groups would give you a sense of the so-called treatment effect, because one group get the treatment of having a smaller tick size, whereas the other would stay at 1 penny. Now, this is one commonly used econometric technique. A similar technique could be used for round lot changes that have a dollar thresholds. You can do that similarly. There are probably other methodologies out there one could use, but the point is that because of different stocks are affected by these amendments in different fashion, it is absolutely possible to study them in one go and discern the distinct impact.
Well, I hear you on that. I mean, I will say we could have done the market data infrastructure changes first. I hear you on saying access fee caps and tick size you see as more integrated, but I think we really could have accelerated those market data infrastructure changes and seen how that worked and then moved to the next. But I'm glad that you're thinking about ways that we can measure the effects. At least one commenter suggested that the Commission's rationale in proposing lower access fee caps is inconsistent with its rationale in pursuing the transaction fee pilot a few years ago. In that release, the Commission stated that it lacks the data necessary to meaningfully analyze the impact that exchange transaction fee and rebate pricing models have on order routing behavior, market and execution quality, and our market structure generally. What has changed 6 years after the Commission approved that pilot that makes adopting the access fee cap reductions reasonable?
Commissioner Peirce, I'm happy to start on that question. So the amendments today lower the tick size, and what we're doing with access fees accommodate this lower tick size. So we proposed an access fee cap of 10 mils, and that's what we're adopting. And we received extensive comment on the 10 mil access fee. A number of commenters stated that the current 30 mil access fee cap is outdated, noting that access fees persist at 30 mils. And almost all commenters agreed that we must adjust the access fee cap given that we are reducing the tick size. Now, you're right, there's trade-offs. A lower access fee has benefits for investors, but you can't have an access fee cap, or it's better not to have an access fee cap that's too low.
I mean, I think that answer sort of highlights one of my areas of discomfort with what we're doing here. I mean, we're reducing from 30 to 10. I understand that we're trying to do this, thinking about how distortions, but we really don't know that 10 is the right number, not 15, not 5, maybe 12, 8. We are to some extent guessing on what that right number is.
I'll only say that there's a lot of careful analysis, so I wouldn't say that we're guessing. I think that it's more that there's a set of criteria that we need to satisfy, and that 10 mils satisfies those criteria. And then the question is, do we think that there's going to be harm from 10 mils? And we don't. We've analyzed this very carefully.
Well, I appreciate that, and I hope that we'll continue to be watching after the fact to make sure that our expectations are met there in terms of not harming anything with dropping it to 10 mils. Many commenters argue that the Commission should not define tick constraints solely in terms of average quoted spread. One commenter recommended a multi-factor test that looked to other characteristics of the stock, such as quoted spread factor, quote size to trade size ratio, and notional turnover ratio. Others suggested other tests that also would look at other factors beyond just average quoted spread. It appears that the general consensus among these commenters is that even under a multi-factor analysis, a stock should not be classified as tick constrained unless its average quoted spread was 1.1 cent or less. The final rule defines tick constrained stocks as a stock with a time weighted average quoted average spread of 1.5 cents or less. It does not look to any of the other factors suggested by commenters. Can you walk me through why we're recommending this sort of streamlined approach and what empirical analysis underlies the decision to make an average quoted spread of 1.5 cents or less the sole component of the definition? Are you concerned that there may be thinly traded stocks that fall within this simpler definition of tick constrained and that will see adverse effects on the execution quality of those stocks?
Commissioner Peirce, I'm happy to address this question. So it's true that some commenters suggested further limiting the universe of stocks by adding criteria. And I think that the first thing to note is that many of these criteria are highly correlated with spread. And that would include a criteria that would go for something like thinly traded. So a stock that is thinly traded is likely to have a large spread and thus would simply just remain in its current status quo. Now, that being said, we did a careful analysis of the suggestions of commenters. And the way that we did this is we sorted on spreads the way we did our main analysis. And then we also sorted on the measure of interest. And what we found is relatively little disagreement when we sorted on that second measure. So in other words, when we looked at this at the end of the tick size pilot, we found that there was no evidence of a benefit that was significant enough to justify the cost of the increasing complexity. And we also didn't find evidence that this policy of spread would cause harm. So it is an empirical analysis. It's in the release and it's based on these double sorts.
Well, I share your interest in trying to keep the tests simple. I think there is value in that. But again, I hope this is something that we'll look at as we follow the implementation. I want to just go back for a second to access fees because this is an area that always bothers me. It's us doing price setting effectively, rate setting. It's not a role that I'm comfortable with. I often think about a world in which there's no order protection rule. And I think in such a world, we wouldn't have to set access fees at all. Would it be unrealistic to just let competitive forces drive access fees?
Commissioner Peirce, if I could chime in here, access fee is part of the recommendation today, but order protection is not a part of the recommendation today. So I'm assuming this is a purely hypothetical discussion.
A girl can always dream.
If this is about order protection, maybe I can, take a stab at this big picture.
So let me just ask the question. Do you think there's any world in which we could not be in the business of setting access fees, where we could just say, you know what, let's leave this to competition? I think that's one of the unfortunate things. We have wonderful equity market structure in the United States, but one of the unfortunate aspects of it is that there are a lot of government SEC decisions about how things work. And I think we tend to have better markets when market forces drive decisions around things like price. And so is there any world that you can see, whether that's with or without the order protection rule, in which we wouldn't be in the business of setting access fees, fee caps?
Yeah, Commissioner Peirce, thank you for maybe reframing the question. I'm happy to start on this question too. I think ultimately it depends on the statute, right? The chair mentioned the 1975 amendments to the securities laws. There, Congress made very specific choice about the words. about the objective of national market system, to make sure it's transparent, to make sure it's competitive, to make sure it's efficient. It should be practical for broker dealers to execute orders, and it should also make it possible for investors to execute orders without undue intermediation from intermediaries. So all of these words are very specific, and the amendments and the current statute also make sure that the Commission review the fees and make sure the fees are reasonable and are not unduly discriminatory. So with all these very concrete directions from Congress, at least at the staff level, we do believe that we are sort of in the business of looking at the fees and making sure that it fulfills the mission that the Congress gives to us. Now, maybe speaking a bit more specifically about the role of order protection, historically has been a very effective tool to make sure that markets are linked together, not only physically, but also logically, making sure that people have efficient access to protecting the best quotations, to set a floor on execution quality, and also to foster competition. Many market observers probably also remember the days when in 2005, when regulation AMS was first adopted. You can see that certain incumbent exchanges lost a lot of market share because of challenger exchanges are able to compete based on the best price. So I would say that it's probably a much more involved discussion on the fee structure and sort of especially coming to OPR. But I know this is a longer answer maybe than you was hoping for, but it is a very complex issue. I think it's important to thoroughly engage with all the stakeholders on this particular issue of OPR and letting market set all the fees without any commission review. It is going to be a dramatic step and departure from the conventional approach. So I would caution that we shouldn't do, yet. It's a hard one.
Well, no, I do appreciate the answer, and I'm not recommending that change without doing study, as I think is important for all the changes that we make around our market structure rules. You mentioned the 75 Act amendments. That was something that Chair Gensler mentioned as well in his opening comments. And I think if I could have whispered in the ear of that Congress in 1975, I would have urged them to remember that markets are really good at figuring out ways to link with one another. And I think especially now that we have technology that makes that so much easier, I think there's a lot that markets can do without having a government regulator facilitate that. We certainly have a role in setting rules, and we have to set rules in accord with what Congress tells us to do. But I do think that we don't need to play an active role in managing these markets, as active a role as we have played, I should say. In any event, we'll stop thinking about hypothetical worlds and now think about the world that we're actually putting into place with the changes that we're making here. How do you expect the rule to affect on-exchange versus off-exchange trading? Do you expect to see any change in where trading is happening?
I'm happy to start on this one too, and invite Kelly to chime in. Commissioner, as you know, today we have a few amendments on distinct aspects of regulation MS. If we sort of take them apart and see, on 6 or 12, for example, we do expect that the amendments by narrowing down the tick size will reduce bid-ask spread. Therefore, exchanges will be better able to compete with off-exchange trading venues, and therefore we would expect to see maybe a higher market share of exchanges. And on 610, although the reduction in access fee cap expect to widen spread in some places, I think we acknowledge that in the draft. And the quota differential between the league exchanges and other trading venues may widen. We do not really expect any meaningful changes in the composition of volume across different trading venues. And lastly, in terms of the new definition of round lot and odd lot, again, the objective of having a new definition of odd lot and round lot is that certain stocks that are priced at very high prices would see artificially wide spread based on the protected quotation on the 100 shares. So by reducing the round lot to 40 or 10 or 1 shares, we will see a narrow spread on exchange. Therefore, the exchange quotations would become more attractive. So there, we do expect to see a higher market share on exchanges. So this is a more of a nuanced answer, really depending on which aspect of the amendments we are talking about.
Well, so I think that's interesting because I mean, this is one of the concerns that I have, right? It's hard to tell what the effect of each piece is because they're going to all be operating together. So do you have a sense, like, if you had to speculate on what the net effect of those changes will be in terms of on exchange versus off exchange, do you have can you speculate on that?
Well, I hate to speculate in front of the commissioner, but based on the 3 different elements we just discussed, I think 2 out of the 3, namely a narrower tick size and a smaller round lot definition, would just narrow the on-exchange bid-offer spread. So these 2 would generally be expected to be positive on the exchange market share. The access fee cap may be more neutral. So again, this is up to the post-implementation study and also evaluation. But if you ask me to kind of speculate now, I would say net on net, the exchanges probably would see a higher market share collectively after all the implementations are done.
Okay, thanks. And then we're I guess assuming that exchanges will be able to maintain what we estimate to be their net capture of approximately 2 mils per share, and thus not adversely affect their business models. This view seems to rest on several assumptions, including that we'll not see a significant shift in transaction volume from exchanges to other trading platforms. For example, because lower exchange rebates are less attractive to liquidity providers, or that exchanges will not need to increase rebates to an amount higher than the access fee caps, perhaps subsidizing them from other revenue streams to attract liquidity. Of course, it's not the Commission's role to protect a particular revenue stream of any market participant, but exchanges do play an important role in our markets. So let's assume that their net capture from access fees diminishes significantly. How might this affect the structure of our markets and the ability of exchanges not only to provide trade execution services, but to continue innovating well? And I think this ties to our prior conversation. So it seems to me that your suggestion is, at the end of the day, this isn't something I should worry about, but just any thoughts on that?
Thanks, Commissioner. Maybe I'll jump in and maybe provide a little bit of information to respond. As we discussed in the release, I think we provide a lot of analysis on the net capture rates, and we do estimate that most exchanges retain an estimated net capture of 2 mils for executions of a protected quotes price of $1 or more. But that net capture rate is not uniform across exchanges, and there has been some estimate that some net capture can go as high in the range up to 6 mils. But what this suggests is, the net capture rate suggests is that the pre-existing levels of the access fee caps are higher than are necessary to preserve the viability of the agency market business model, which the Commission has, analyzed, review, and coming to when it's adopting Rule 610C originally, and what we looked at today as a staff in making these recommendations.
Okay, thanks. I guess just turning to another issue that I know everyone cares a lot about, which is how retail investors will be affected and how institutional investors will be affected. So do you expect that the rule will narrow spreads for retail investors? What about for institutional investors? Any thoughts on that?
Commissioner Peirce, I'm happy to jump in here. So what we expect the rule to do is to reduce transaction costs. So the amendments to Rule 612 will lower quoted spreads on exchanges. Now, the amendments to 610 may slightly widen quoted spreads, but they will also reduce access fees. So on net, you will see from 610 potentially no change or a reduction in transaction cost depending on the stock. And for 612, for those affected stocks, we would expect a reduction. So given the lower cost of trading on exchanges, that's going to help institutional traders, and it's also going to help retail traders. Now, in terms of, breaking it down, so for retail investors, what we know is that wholesalers currently internalize some percentage of retail orders, and some of them are internalized at the NBBO, some are internalized within the NBBO. And then for those that are internalized within the NBBO, the relevant metric is distance from the midpoint. And that's not expected to change under these amendments. However, as for all investors, we do expect retail to benefit from the lower cost of on-exchange trading.
Okay, well, I think what the discussions this morning have suggested is that it's really important that we see whether our expectations about the rule are met. And so I appreciate you including in the rule some parameters around what a study would look like. And I look forward to seeing the results of that. What is the commission going to be looking at specifically in that study, and how will we know based on that whether these amendments have been successful or not?
So some of the things we could look at as part of the review would be quoted spreads, effective spreads, realized spreads. We would want to look at these net of fees and rebates. We'd want to look at this for the stocks affected by Rule 612, and Director Zhu gave an example of how we might get more precision in that respect. So the first thing I believe to look at would be, did the cost of trading come down in response to the amendments of Rule 612? And that is absolutely something that we could be looking at. In terms of Rule 610, there are stocks that are going to be affected by 610, not affected by 612. We could look at what happened to quoted spreads to see if they respond in the way we think they will. To rebates, we can look at what happens to order flow on and off exchange. Just mentioning that we do expect, as Director Zhu mentioned, on net order flow to move towards exchanges as a result of these amendments, but we'll certainly be looking at that.
So if we're sitting down 3 years after the after the amendments are fully implemented, and I ask you, so Jessica, has this been successful? What are you going to point to say, yes, it's been successful?
I think we would look at just a comparison before or after. Like the simplest thing to look at would be a comparison before or after on transaction costs on exchanges to see, if they went down, and I'm going to be looking for that negative number, and I'm going to hope to see those two little stars indicating statistical significance.
And then also checking to see whether retail and institutional investors actually are, as a result, have lower transaction costs, I assume.
We can look at that. I mean, one thing we can look at is looking at different trade sizes and seeing how they are affected, for example.
All right, well, we're hoping it will be successful, but there's a chance that things don't work the way we anticipated. We don't have any express provisions in the rule to make adjustments. So if we do see that this isn't working as intended, what do you all recommend in terms of what can the commission do if these amendments aren't working as intended?
Commissioner Peirce, I'm happy to chime in here. I think staff in trading the market and as well as staff in DERA have done a very thorough review of all the comments and the data, and we have considered the recommendations extremely carefully over the last 21 months. And we have a great deal of confidence in making these recommendations to the Commission. Now, of course, we will continue to monitor the market and the implementation of these amendments and their operation after adoption. And as you and Director Walker just discussed, the study is another mechanism for us to look at the changes more formally after implementation.
And what if the study shows that we were completely off base and these amendments are not working as we anticipated? Then what?
It's up to a future commission.
So we would have to go through the full rulemaking. There's nothing, if there are disastrous consequences as a result of the rule, is there anything that we could do short of a fresh rulemaking? And there
Commissioner,
might be more
once
of a
again,
question for GC if
yeah, I was going to say we hate to speculate, but yeah, I see Megan is here. Turning to the general counsel.
Good morning, Commissioner Purse. On this topic, I would say the commission will have all the tools that it has available in the ordinary course to deal with any issues that may come up. If I understood the question correctly, it was a question about if there were a disastrous consequence, what could the commission do? And of course, the commission does deal with those types of situations through various mechanisms, including potentially exemptive relief. But as Haoshang emphasized, obviously the expectation is not that we will encounter that here, but if a future commission did, they would have those tools available.
Yeah, well, I agree with you that the expectation is not that there will be severe adverse consequences. I wouldn't be supporting the rule if that were the case, and I think others wouldn't be supporting the rule if that were the case. But I think we need, given the magnitude of this change, I think we do need to be paying attention to what the effects are. We need to be listening to people in the market, and we need to be studying what the effects are. And so, and of course, talking with folks during the implementation period to make that go as smoothly as possible. I don't have any additional questions. Thanks.
Thank you, Commissioner Purse. Before I hand off to Commissioner Crenshaw, I want to thank all the commissioners that weighed in on the possibility, and it's in the release as the public will read it, about studies and looking at this in a number of years. And I know, Commissioner Purse, that you spent a fair amount of time with Jessica Wachter on this, so I thank you. But all 5 commissioners have weighed in on that. Back in 1975, when Ray Garrett had the job of chairing the agency, I think in his front office was Harvey Pitt, and they worked on that legislation with Congress. We had a different market structure, but we had a market structure that Congress reacted to, even had fixed commissions. But a key part of it was linking together the markets. And it was 1978, just 3 years later, that our predecessors first put in place something to link the markets. It was partly to get rid of a New York Stock Exchange rule. Historically, if I recall it, the rule didn't allow off-exchange trading. And so I think the commission wisely 40 some years ago, almost 50 years ago, got rid of that, said, no, you can't forbid somebody to trade. But then there's this linking of markets in 1978, which was the intermarket trading system, I guess, ITS, if I recall, and then the order protection rule in 2005. So I know they were hypotheticals. We didn't take that up in this rulemaking, but I think it's got a long and important history based on Congress and based on a lot of commission work from 1978 to 2005. So maybe I'm just saying something that you already knew, but.
No, I mean, I certainly know it's been a lot of work over those years. And I think even at the time that the 75 Act amendments went into effect, the commission was casting about a little bit to figure out what exactly the nature of its role should be. And I think that is something that we should continue discussing to this day, how active our role should be in trying to micromanage markets. And so that's my point. I think people can disagree on that, but I think it's a conversation that we need to continue having.
No, and I think you're right, because ultimately it's about how to get the best for the investors and promoting capital formation in a way that links this great market together. And I don't know the number we had in 1978 or 75, but now we have multiple exchanges. Of course, there's often conversation about the big 3, but there's others as well, and how to link it together in this national best bid, best offer, but and drive efficiency. Commissioner Crenshaw.
Good morning. I think it's fair to say that equity market structure contains multitudes. And in that poetic spirit, on this rainy morning in Washington, D.C., the Commission will vote on amendments that can be broken into several components. As you've already heard, 1, reducing the tick size for certain stocks. 2, reducing the maximum fees that exchanges may charge investors for execution against protected quotations, or access fee caps for short. And 3, requiring exchange fees and rebates to be determinable at the time of execution. In addition, today's amendments will accelerate the implementation of the round lot and odd lot information definitions from the Market Data Infrastructure Rule and add a new best odd lot order data element, or BOLO. I thought of many jokes to add there, and none of them I thought would actually fly, but I definitely thought of a couple that rhyme with BOLO. But adding that as part of our odd lot information definition. And as I noted during the proposal phase, many market participants have suggested that trading in tick-constrained stocks would benefit from a smaller minimum tick size, though the specifics of those suggestions varied. In addition, data analysis has shown that it would be easier and less costly for investors to transact in these stocks if they were allowed to quote at increments smaller than 1 penny. Today's amendment addresses this issue by adding a new tick size of a half penny for these stocks. This will benefit investors and market participants by allowing such stocks to be priced more efficiently and competitively. The second component of the amendments will reduce the access fee caps for certain NMS stocks. Currently, many exchanges charge the maximum fee and then pay out nearly all of that fee as a rebate to compensate liquidity providers. Though the exchanges retain a small amount for themselves, this practice distorts the price that is actually available to investors. Therefore, today's amendment, which reduces the access fee, will allow exchanges to retain that same net capture for executions they were already keeping and continue to use rebates. Reducing the distortions in the market associated with the fee rebate models that have developed under the higher access fee cap should help improve market quality and preserve the integrity of displayed prices, which will reduce costs for investors. It remains to be seen whether this will be helpful enough. The third component of the amendments will require exchange fees and rebates to be determinable at the time of execution. In recent years, the exchanges have developed complex fee and rebate schedules, many of which include tiers or other incentives based on the broker-dealer's trading volume. One of the issues with this model is that because the fees are calculated based on monthly volume, broker-dealers and their customers do not know what the fees are until the month's end. I think we can all agree that it's preferable to know what you're paying up front. Here, customers' lack of timely information and certainty about their fees and rebates can impact their choices. The amendments will provide much-needed transparency. Finally, the last part of today's amendments will accelerate and build upon certain common sense changes that the Commission adopted in the Market Data Infrastructure rulemaking. This aspect of the amendments will improve information available to investors and other market participants about better prices available in the market, resulting in, as you've heard from, I think, pretty much everybody today, more transparent pricing. Thank you again to the staff in the Division of Trading and Markets, the Division of Economic and Risk Analysis, the Office of the General Counsel, and everyone else who contributed to today's rulemaking. It's quite an undertaking, but I think it's an important step forward, and I'm happy to support today's rule. Thank you.
Thank you, Commissioner Crenshaw. Commissioner Ueda.
Thank you, Chair Gensler. Good morning. Thank you, Sean, Kelly, and Jessica for your presentations. Today, the Commission is adopting a change in the required minimum pricing increments, also known as the tick size, for expressions of trading interests in the national market system stocks. In addition, the Commission is reducing access fee caps and requiring more transparency of certain better priced orders. As the Commission observed when it originally adopted Regulation NMS, a minimum tick size can encourage the provision of liquidity by constraining the ability of market participants to gain an execution priority over pre-existing orders by providing an economically insignificant improvement in the bid or ask. However, if a tick size is too large, It can discourage price competition on national securities exchanges and cause market participants to seek out other venues that might lower transaction costs. Given that optimal tick size can depend on the characteristics of the market and the security being traded and may be affected by changes in technology and communications, the question of the required minimum pricing increment is one that should be revisited on a regular basis. It has been nearly 20 years since the Commission last did so. I'm pleased that the Commission has now undertaken that effort. The comment process regarding this proposal has allowed for substantive feedback from stakeholders and market participants to inform the final rule. One part of the proposal would have required minimum pricing increments on trade executions, in addition to requiring them on expressions of trading interest. This would have constituted a dramatic change in how NMS stocks are traded and executed. Indeed, one significant concern expressed in the comments was that such a change might undermine price improvement opportunities for investors. Fortunately, this part of the proposal was not included in the final rule. Another part of the proposal introduced 4 separate tick sizes based on different ranges based on time-weighted average quoted spreads. Commenters raised concerns that this approach increased the complexity and potential cost. In the final rule, a more incremental approach is being adopted, with the Commission not moving forward on this highly complicated approach, and instead adopting only one additional minimum pricing increment of a half penny. The final rule contains a number of other adjustments, including a longer implementation period for market participants to make systems changes with respect to increased transparency requirements for better priced orders. Access fee caps, which place a ceiling on the fee for accessing the national best bidder offer, will be lowered. Despite the comments, I find it difficult to determine ex ante whether traders will enjoy lower overall transaction costs in light of this change. Determining a specific cap for the access fee is not a simple proposition. I have concerns whether the Commission has selected the correct threshold. However, I've been assured by the staff, which is reflected in the release, that they will be studying the effects of this change and reporting back to the Commission. The final rule accelerates the implementation of certain odd lot and round lot information in order to enhance transparency in the market. For the most part, these changes were already included in the final rule on market data infrastructure that was adopted by the Commission under the leadership of then Chairman Jay Clayton on December 9, 2020. While the availability of this information may, in some situations, require adjustments to broker-dealer business models to better serve investors, I've been advised by the staff that there is unlikely to be any substantial unintended consequences or costs regarding this change. To conclude, this is an important rulemaking for our market structure. By its very nature, market structure issues are fraught with uncertainties when estimating the impact of regulatory changes. Across time, the Commission needs to continue to re-examine and potentially recalibrate as to whether we have properly gauged these changes. I'd like to thank the staff and the divisions of trading markets and economic risk analysis, as well as the Office of the General Counsel for their efforts. And first, I want to appreciate the conversation and the comments. In addition to their opening statements from Chair Gensler and Commissioner Peirce, I have, I think, share a number of the same concerns. Earlier this week, we announced an enforcement case called Zymergen, which had to do with projections. And it seems like we are doing a fair number of projections in our economic analysis as to whether or not we know the effects of this rule. Now, I have no doubt that the staff has worked very hard, but ultimately, I just want to make sure I understand what Jessica said. At the end of the day, you've done the best research. You think that, for instance, on the 10 mils access fee, that is the right threshold, but that is really your best judgment at this time based on the information. You're not making a factual that will happen in the future as a factual matter, are you?
I'm sorry, what exactly Well, let me step back. I think there's a question here about, you're asking, what do we know here? And I wouldn't necessarily characterize these things as projections. But I think what we know and what is borne out, not just by what I'm saying, but you can see it in the comment file, and certainly it's in the analysis in the release, is that you want the access fee cap to be low. Access fees are not going to get lower on their own. We need to have a lower access fee cap. When I say low, what does low mean? Well, it means less than half of the ticket size. You don't want it to be too low because you don't want to adversely affect, if you can help it, because you don't want to adversely affect existing models. Those things are known. And then, we've got to just do the best job we can here, given that we're lowering the tick size.
Well, let me ask this in a different way. Is what we've said in the economic analysis of what we expect to be the consequence of this, is that a statement of fact or a statement of opinion?
I think it depends on what part of the economic analysis that you're talking about. I'm not sure I would use the word opinion, but we are.
I'm just trying to, you made a number of assertions, especially in response to Commissioner Peirce, about how the staff has worked very hard on trying to analyze what the possible effects would be. As Commissioner Peirce said, and I'm in the same boat, whether the right number for the access fee is 10 mils or 5 mils or 7.5 or 15 or 12.5. I'm relying on your work, and as I understand it, you have, and the staff has worked very hard and to try to think about what is likely to be the best number. But you can't. But are you telling me that is the best number? I have no doubt that is the conclusion you reached, but you seem to be trying to base that on what you think the future effects of this change is going to be, which strikes me as a projection.
Commissioner, you can have complete confidence in our analysis. I have complete confidence in it, and I'm very proud of the work of the staff. I really do stand by the analysis. And yes, it's a statement about the future, but that's what we got to do here.
All right. And these are things, and I would say we have to make these decisions all the time ex ante. And I don't expect our economists and the staff to be 100% accurate forecasters on what we should or shouldn't do, which is why it's so important to go back and take a look at what we did, and did it result in the intended effects, and more importantly, determine whether or not there were any unintended effects of that. And so I appreciate that we're going to have this look back, which I think is important. And I think, as you described, it will examine, in order to determine what the effects are. We'll need to look at activity before and after implementation of the rule. Is that correct?
We look forward to doing so. We in DERA, and I'm sure in Trading and Markets, are going to be following this with great interest.
And then when this study is completed, from my perspective, we've talked a lot about transparency. I think we ought to be transparent in our observations, and I realize others may have differing views, but I think that's important as a regulator, that we are open and transparent. I would hope that we don't put out a public report only if we deem it a success, but if we find there are problems, that we bury it and don't let it see the light of day unless someone tries to do a FOIA request on it. With respect to, I want to go back. I think this is something that TM answered for Commissioner Peirce about the timing of this and 605 data, and that we didn't need 605 data for this particular rulemaking. But we have done a number of rules in all aspects saying we need more data to understand the scope of things. Yet we don't seem to be waiting for any of that data to come in before making some conclusions. What's the use, Ashang, of collecting and recording all this data if we're not going to think about it before sort of jumping taking the next step forward. It kind of reminds me, as I mentioned, market structure issues are fraught with uncertainties. It kind of reminds me of a rickety old bridge. You're always trying to figure out where to make the next step. Why not think about this as an ongoing iterative process, get the data, look at it, inform what we do, and then move forward?
Commissioner Ueda, thank you for that question. Happy to chime in here. As Kelly discussed before, we do believe that 605 as a transparency and its disclosure rule is distinct from the recommendations we're making today. So transparency and the disclosure is about execution quality of various market centers and broker dealers. And even if we have the best disclosure, it's not going to fix the constraints on, say, tick size, all out and round lot. So these are distinct questions. You mentioned the word bridge. Maybe if I could use a metaphor, metaphors are not always precise, but you got the idea. We can think about the transparency of 605 as about adding different gadgets in the cars. You measure the speed, fuel economy, the temperature, elevation, all of that. And if you do all of that, we all have the perfect measurement of the car. It does not solve any problem of a traffic jam, right? If there's a constraint in the traffic, it is still jammed, no matter how good the measurement is. So that is why in this recommendation we're recommending today, we're recommending the Commission to make certain changes in the broad market parameters, such as tick size, such as access fee cap, such as round lot and all out, that address concerns at a market-wide level rather than individual broker-dealer market center level. So in this sense, they are distinct. That is why we have a great deal of confidence that even without having the new 605 data, we are able to relax these constraints and achieve a better efficient market and more transparent market, independent from 605.
Right. Well, in this one, we are asking for a lot more market data information and transparency, and it strikes me that some of these would go to the market quality. Or in evaluating market quality and again informing some of our judgments. And well, hopefully, at least we've got some other things out there. I think we talked a lot about competition, which I think is an important part of driving market behavior, and it is, with respect to transparency on transaction costs and fees, the market will respond. And I just want to echo what Commissioner Peirce said, is that our role as a price setting agency, I don't think has been historically great. We're looking at this for the first time in 20 years. In other areas, whether it's our oversight of, for instance, some of the proxy solicitation fees that is being charged to public companies and it gets footed by investors, is also been not good. That's why trying to figure out ways competition. And while I appreciate your legal analysis of the 75 Act amendments, I do view that Congress did want to have competition in all forms, both including venue competition. I think Chair Gensler mentioned fixed commissions. At one point, there were commissions you couldn't charge less by law, and once that was done away, look where we are today. Execution costs, particularly for retail investors, is so much less than what it was in 1975, and that was done through competitive market forces, not through government regulation. So that's all I have. Thank you very much.
Thank you so much, Commissioner Ueda. Commissioner Lizarga.
Thank you, Chair Gensler, and thanks to the staff. The Commission is reforming how exchanges quote individual stock prices, the fees investors pay to access orders on exchanges, and the price transparency of smaller orders. In a change from the status quo, the amendments will also provide real-time disclosure of exchanges, access fees, and rebates. The rules governing current market practices have not been updated in almost 2 decades, but the Commission's reforms will result in lower transaction costs that benefit all investors. Reducing the minimum increment for stocks that currently have a price difference at or near 1 cent for the highest purchase price and lowest selling price, or the spread, will improve market quality. This change will address pricing inefficiencies caused by artificially wide spreads that could be lower if they were set by market forces. Reducing access fee caps will increase the transparency of stock prices on exchanges. The total costs of listed stocks, including fees, are not currently transparent. High access fees also create potential conflicts of interest between firms and their customers. Firms have an incentive to route orders to exchanges, either to take advantage of higher rebates or to avoid higher fees. Today's reforms will diminish this incentive and provide greater transparency to customers about costs at the time of trade. Lastly, the reforms will increase transparency and availability of information regarding better priced small orders in the market. I am pleased to support today's reforms, which are designed to strengthen market quality, increase price transparency, and foster competition that will benefit retail investors and all market participants. Thank you.
Thank you, Commissioner Lizarga. Thank you to all my fellow commissioners. There's a lot of work that's going on here, but now I will call the question on how commissioners vote to approve the staff recommendations.
Before, I just want to jump in and say I really want to express my deep appreciation for the staff's deep work and analysis in all of the rules that we do, and including this one. And any suggestions sort of that this is guessing, I think is concerning and not inaccurate. I think it's a deep work and deep appreciation that we rely on for our rulemaking sort of across the years that we have been doing this. So I just want to sort of clarify that and make sure that you know, we appreciate all of the hard work and analysis that we do, and always go back and review what we have done prior to make sure that what we have anticipated is going to happen actually happens.
Commissioner Peirce?
I'll say that I think that the work, there's been a lot of work that has gone into this rulemaking project, and I very much appreciate that. I've really appreciated my conversations with people in TM and DERA as well. I think there's nothing wrong with acknowledging in an economic analysis where you're making assumptions, what those assumptions are. That's part of an economic analysis, and I think that is part of what I was trying to draw out, which is that we don't have perfect certainty on things, and that is why we do need to ultimately, at the end of the day, go back and see whether we got it right or not, and that's what I'm looking forward to. But I do support today's recommendation, so my vote is yes.
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 I do support this. I'm about to vote, but I would say just tremendous work by the team over many years. I mean, when I got to the commission 3.5 years ago, Dan Gray in the Division of Trading and Markets, who's still very much contributing, had worked on the 2005 releases. And I remember the first meetings with Dan, with Andrea, with Kelly, with so many others in trading and markets, Shang, of course, so many in Division of Economic Risk Analysis. But I share all of the commissioners' view. I think it's good to take a look. This is 19 years, but as I said in my statement of support, over and over again, folks have been coming in saying, and Dan Gray could tell us too, it probably happened just a year after that 2005 rule happened. Well, can you change this? Can you change that? And so forth. So it's no doubt somebody in the future, whether it's 19 years from now or some other time, a future commission will say, all right, markets have changed. What do we do? What do we shift? Because technologies are constantly changing. But I really am proud of the work of the economists here and what they've put forward for us to consider. And I think this is pro-investor and pro-capital formation to lower the cost in the system. But there's some assumptions in there for sure, Commissioner Peirce. But my vote is yes. And with that, I want to thank my fellow commissioners, thank everybody for working on this. A unanimous vote on a very important set of rules here. We'll send to the Federal Register. But with that, I'll call the meeting adjourned. Thank you.